2022 may have been a choppy year for investors with largely flat returns amidst recession risks. Foreign flows remained turbulent as US Fed embarked on a rate hike spree. RBI too had to follow suit. But there's one category that has shown resilience, remarkable resilience indeed. Domestic retail investors are pouring money into the stock market like never before. SIPs have stayed above the 13,000 crore rupee mark for 2 consecutive months. Mutual funds are at an all-time high. What is driving this trend, and is the Indian market finally maturing, or is this an aberration? We're going to be talking about this ahead on the show with two fantastic speakers. But first, let's look at some analysis from my colleague Sharath.
Well, yes, a very strong, resilient performance by the retail investors in the year 2022, despite the volatility in the markets being seen. Now, over here, if you see the SIP levels are their lifetime high levels of more than 13,000 crores, and this is being sustained for the second straight month. Now, going ahead also, if you look at the numbers, especially the demat accounts, that has also been crossing the 10 crore mark. And if you see the retail mutual fund folios, that has also been very strong, and that is going up more than 11 crore and it's going really strong. And the additional happening across the month, that is also pretty good. Even the SIP accounts, that is also coming in at record levels, and it has touched the 6 crore mark, and that's a very big number, especially for the retail investors, and seeing this in a volatile year of 2022. Now, the retail AUM numbers, if you see, that is also going up. And it's almost more than 20 lakh crore rupees, and that is also coming despite some corrections seen in the middle of the year as well. Now, apart from the retail AUM, let's see how the DI's cash flow markets has compared with the FIs, and over here we see there has been a change from 2020, and you see the DI numbers going up more than 2.5 lakh crore rupees already for the year 2022.
Ajay Srivastava, CEO of Dimensions Corp Finance Services Private Limited, on the show with me. I'm speaking with Nikhil Kamath, co-founder of Zerodha True Beacon. Welcome to both of you. Great to have you on the show, where we're talking about retail investors and whether they've finally seen the light or are they treading on dangerous territory. Ajay Srivastava, let me begin with your take. The numbers are fantastic. There's one statistic out there which says for every 100 rupees foreign investors have sold, domestic investors have bought 93 rupees. Clearly, retail investors have found their faith finally in Indian markets. SIPs are doing great. We've put out all the numbers over there. What do you think this comes down to? Is it the TINA factor, like we say in politics? There is no alternative.
You know, you named it. I think it's a straight function of a negative real interest rates that are in the economy for the last 5-7 years, with a deposit rate of 5 to 4% and inflation at 8 to 10% minimum on the CPI. Every single person find that his savings actually are going down. And therefore, what is the answer? The answer is go to equity markets. None of them have made returns. The fact is that mutual funds or anybody over a 3-year period have not beaten the debt returns, have not beaten gold at the end of the day. But on the hope and on the single fact that someday there will be a payday on the equity market, this rush carries on, and it will carry on because till the time the real interest rates don't go positive in this Indian industry, they have gone marginally positive now, but unless they go about a 3 to 4% positive over the inflation rate, you will find this trend going. And the moment the interest rate goes positive, and the real interest rate goes positive by about 2% plus, you will find the trend going down. Now, the good part is it gives strength to the economy, no doubt about it. But has it given value to the investors? My answer perhaps would be no, and investors would still be disappointed who are putting in money at this time, because the threshold for Indian investors is not less than 14 to 16% return minimum on an equity portfolio. And that's not coming their way. The index is up 6%. So faith is high, but the reality is it will be very disappointing. It's already been disappointing. It'll be more disappointing because you will never make more than your debt return at this point of time in the next 12 months or 18 months.
You know, that's interesting. Disappointing depending on what expectations are. That's an important caveat when you say disappointing. Nikhil Kamath, how do you see this retail investor rush in 2022? Do you think it will sustain, and do you think it's good for the Indian equity markets as well as for individual retail investors?
So Tamanna, firstly, I think we need to kind of take cognizance of how big retail is out of the overall market. If one were to consider retail alone, the number is 7.5% of overall market. If you were to even assume a large part of mutual funds are funded by retail, let's add another 7%. You add HNIs to that at another 1 or 2%. I would say at about 15%. Retail investors do not necessarily determine market direction. FII and DI flows, I think, have a significantly larger impact. We were doing a research paper on FIIs versus DIIs. Like you said, they are inversely correlated. When FIIs buy, DIIs sell. For all the retail tracking these numbers, I think DIIs get it right more often than FIIs. In our research, it showed about 55% of the time DIIs are right and about 35% of the time FIIs are right. But that being said, I second what Ajay was saying. I think where we sit today, if a bank FD were to start giving 7.5% like it is in many cases, and equities which have traditionally done about 11-12% a year, retail really have to ask themselves if the additional risk of being in equity, the volatility, is worth having for that 2.5-3% alpha over fixed income or bank FDs, which everybody in our country has access to.
I'm surprised to hear you say that, Nikhil Kamath, because your company has been the gateway and the champion for retail investors, especially those who discovered it in the pandemic. Why are you so circumspect?
Well, I'm always circumspect, Tamanna. I have been for a long time. Globally, markets have corrected quite a bit. I would say everything from America to Europe to Southeast Asia, everything is down 30-40%. India domestically is closer to our all-time highs. And I think in such a connected world today, if the rest of the world is slowing down, it would be very far-fetched to imagine that India could be immune from that. And just by virtue of how expensive multiples are today relative to our own past, I would say, it's not always right to be in equities, and it's not always right to have unhedged products and vanilla exposure to equities. If I were to advise someone today, I would probably advise being hedged, diversifying, having some gold in your portfolio, and having a more holistic approach on building a portfolio.
Ajay, I want to come to you on that. And I'm actually quite glad that both of you are striking a cautious note at a time when you hear only very, very congratulatory sounds and excitement about retail investors. I mean, some would argue that it's finally the time of the retail investor. They've finally figured it out that, long-term investments will give them the returns that they need.
Tamanna, long-term investors don't give any returns. If you look point to point, no stock has given return. Even the best of stock, Aisha, Reliance, you name the stock in the world, it will not give you return. This is the age of being smart, churn your portfolio, because if you're not churning the portfolio, you're not going to make a return. If you look at any stock, let's say sugar today, you're mentioning has a major upside.
Right.
It went up, went down 40%, and on the 40%, it grew 17%. So suddenly, if you see the headlines today, sugar goes up by 17%, but no headline will say it went down by 50%. So, so the point remains that investors, this long-term model is dead. Companies share price doesn't remain, it falls. Every company, including Apple, share price fell at this point in the US. In India, every price falls. So if you don't book your profits, tough luck. And retail investors, you're saying time has come. Of course, time has come. We are very strong and it's an anti to the FIs. But we are so exuberant about equity portfolio that even today people are buying shares. I'll give you an example of Jet Airways. That airline is not going to fly. It's dead. The RP has made more money. Resolution Professional made more money than either creditors got it, or investors got it, or the employees got it. But people still believe that airline would fly. Now, if someone can buy Jet Airways today, you can imagine the exuberance in the system today of the equities. It's good to be exuberant about things, but I think
Ajay, if I can ask you a quick counter, is specifically on the example you gave. So the investors which are coming into Jet, are they coming in because they have some big, great fundamental faith in that brand? They have some brand loyalty, they love Indian aviation, or is it that they want to make the most of that arbitrage which may be available if there is any positive regulatory announcement, etc. They're trying to play the game, isn't it? It's not like there's some great fundamental faith.
Well, I simply say, Tamanna, if you want to play the game of suicidal game, might as well go skydiving. You'll get you better thrills and guaranteed thrills. Believe me, spending money on a stock like Jet Airways and having a diving in your portfolio, neither will give you the thrill and will give you sleepless nights. So if you really want to go thrill based, go skydiving. And if you really love thrill more than that, take away a parachute as well and skydive. Believe me, that will sound better than investing in stuff like airline of Jet Airways, which is not going to fly.
So what do retail investors do? Do they stick to SIPs where they don't have to, because a lot of retail investors want to be in the market, but they don't have the time to do this kind of churn, to track it? I'm going to take that question first to Nikhil and then back to Ajay. Nikhil, so what do retail investors do? They may not have the time or the effort or the inclination to be that knowledgeable. SIP seems to be easy. Do you think that's the way to go?
I think SIP is a good idea, but overall, if I had to recommend something, would be additional diversification. Maybe retail can, look at getting more fixed income products, getting debt, which was not available up until now at as attractive rates as they are today. And I think they're bound to get more attractive in the near future as the interest rate cycle continues to look upward. So I would say if you had 70% equity exposure or 80% equity exposure, it wouldn't be a bad idea to pare that down, put some in commodities, put a little bit in risk-free fixed income or close to risk-free fixed income and have a more diversified portfolio. Again, I think one has to be cognizant to the fact that India does have many things going for it. We have an incumbent government which has had stable policy making for a long time now, and it looks to continue. If you ask foreign investors even today, many of them will tell you they're circumspect about their own geography. But when it comes to India, everybody's optimistic because of the narrative we have pushed and the consistency we have displayed as a country in a geography where I don't think many other countries have had that in the recent past. So there are positives for India. So I would recommend, continue to hold exposure, but maybe the way to do it is not have 100% of your money in one asset class like equity, but you kind of split that up into some debt, some commodities, and get a more balanced portfolio going.
So, Ajay, I'm going to, of course, ask you about your advice for retail investors, but also with this perspective. Investment in equity markets is usually aligned with or drawn as a parallel to faith you have in the Indian economy. It's supposed to be a mirror to the Indian economy. That's why you hear a lot of times this is the fastest growing, brightest spot. You want to bet on the Indian economy, bet on equity markets. Do you think that holds true?
I don't think the connection between an economy and markets have held true for any geographies in the world, and certainly not for long periods of time. In fact, at one point of time, it became inverse that the worse the economy did, and there was a need that the central banks will come and pump in more money, and the markets went up. Okay. So the quarter where the GDP results were good, the market had a tantrum. The quarter GDP results were low, they said, yeah, new money is going to come in, lower interest rates is going to come in. So, so the correlation is not so established in an economy like, particularly in an economy like India, where a large part of the economy of India does not correspond with what's available in the stock market. The agriculture sector, etc. It has no meaning in terms of the stock market at the end of the day and the government interventions that goes with it. So I don't think it's economy. I think it's, without being jingoistic, I think there is, for an Indian investor, he has to feel strongly about India. It's a good economy. The question is, are you buying shares to give value? I don't think so. You need to use your equity and your money to vote for a country economic policy. I think you need to use your money to vote for the fact is that are you feeling lucky about where you're investing? Will you get greater than debt return with the margin that Nikhil was talking about, 3 to 4% margin? Is that good enough to take all the risk? That's it. Let's not get into whether it represents good. India is good. We are good. We are Indian citizens. I have a lot of my money in India, but that doesn't mean anything. It means the fact that I still need to make a return on my capital. And I need to be pragmatic. And the point you asked is, one paradigm which has changed is investors need to book profits. I think that's the bottom line. you stay long enough, you make nothing in the Indian, or not only Indian, global equity market. You book profits, there is money, real money in the bank, not paper money in demat.
Give us a guide to that. So, assuming a bulk of Indian retail investors today are in SIPs, and they have been told, what they have been told is keep putting in the money, forget about it for 3, 4, 5 years, and then you look at it, when you need. There's going to be a pot of gold at the end of the rainbow, akin to that. So, what do you mean when you say keep the churn? Give us a clearer guideline to that, Ajay.
See, for instance, if you look at these sectors, like the IT sector, a classic example of IT sector. The moment the US economy went into a tizzy, it was quite logical for everyone to know that IT sector will take a hit in the manner. So when you look at IT fund, if you had not booked the profit, there was an issue. When the US market went into tizzy, the US funds, people did not book the profit. When you look at Indian market, the large caps of India. Now, Indian index is at this point around 6% for the year. There is no way it can grow beyond what the economy is growing at the end of the day. The economy is growing 6%, the index has gone up 6%. Remarkable correlation, but that's actual fact about it. So if you look at sectorally, you need to find a way to book money per profit. Number two is, if you made a 20-25% return on your portfolio, whatever the composition is, multi-cap fund, small cap fund, large, whatever combination you, I think it's a good idea to take 30-40% of the profit off the table and hold the money, fresh money. You can keep saying that long term it goes well, but the fact remains that if you look at a return, say Jan till now, it's nothing. When you look at a return last June to now, it's fantastic, absolutely. So if you are doing that equated SIP model and not a believer of it at all, and the time when the market crashed in the June or September or whatever it is, you are still putting the same money as you put in 18,500. That's not logical, does it, Tamanna? That doesn't sound logical at all, that I'll put the same money every month, irrespective whether the market is at 10,000, 12,000, 18,000, or maybe 20,000. So I would say in cash at 20-25% return, keep your powder dry. There are always corrections in the market, and sectoral flow has to be churned. There is no question about it. Some sectors will do well. And I think one of the problems in India will have and continues to have is government policy change. Although consistency is there, you had a steel policy, destroyed the steel stock. You had sugar policy, you saw the sugar correction. You had the oil windfall, the oil companies went for a tizzy. So there is a lot of government intervention as well, which happens. So before government moves into tax to supernormal, get out of the sector, book your profits at the end of the day. So I would say 20-25%, book the profit, hold the firepower, for corrections will happen and you need to exploit it. Did you put enough money last correction? If you have not, hold your firepower. I would say put in fixed income, take it out when the real market has given you good positive way to enter the market and balance it out. Just to be consistently close your eyes and keep putting money in a box, I don't think it's a wise idea in the present volatile markets.
Passive investor, you cannot afford to fall asleep on the wheel. Nikhil Kamath, I want you to come in on that. When we say, look at churn in your portfolio, how exactly would you suggest retail investors do that?
Well, it's a tough question. If you were to look historically in the last decade or two, I think people who were passive and let money compound for them in any geography across the world, if you entered an ETF, one could argue that passive has done better than active in many cases. This churn is also a complicated word because churn comes at a cost. You may be right, you may not be right, you might make wrong trading decisions, but outside of that, each time you enter and exit a particular stock, you pay STT, you pay commissions, there's an impact cost. So all of this does affect you in the long run as well. So I don't think I can make a unidirectional call on whether active is better or passive is better. I think the bigger call is in trending markets, maybe passive is better. In flat to volatile markets, maybe active is better. What will be the scenario in the next 3 to 5 years is probably impossible for anyone to call. But maybe a combination of active and passive is the right way to go.
That we haven't really spoken about is how FOMO is driving equity participation. People are reading the stories, they're hearing from their friends about those who made tons of money. And they're like, why can't we? So we have to look at that story. I think the interesting part of it is that the average Indian investor is refusing to be happy with the bare minimum and play it safe. They're ready to take risks. How can that be channeled positively is the question. I want to end this here, but I want to thank both Ajay Srivastava and Nikhil Kamath for speaking with us. We've had a fantastic conversation. Hope it's been useful to our viewers. Even as we look at how markets performed today, it's been a new week on the Lal Street.